welcome everybody to the second quarter Global Markets and Economic Update. My name is Chris Rawson. This is my colleague, Bryan Bly. We have an agenda for all of our meetings. I'm going to review that with you. Before we jump in, please add any questions you may have in the Q&A. As we go through the material, feel free to add your questions. I added a feature that allowed people to upvote and contribute to the question. So feel free to participate in that area. And as I've noted here, we have our prepared comments. Bryan and I will go, could be less than 30 minutes. Then we'll shift over to the unscripted Q&A, and we will wrap up from there. So why do we host this event? The reason we host this event is for you. We want to make sure, well, let me just share. Our focus is to guide our clients to feel confident in their long-term financial plan and to recognize the signs of our current outrage culture due to manipulation of data within the news media. So part of the reason we host this is to show you the charts and the data that's relevant and not misconstrue the data in any way to, raise anxiety so that basically some of these people can sell advertising. That's unfortunately the world we live in. Okay, this is our agenda. We are going to start with the US, and the format's the same. We're going to cover the highlights, the good components, and the bad components within each of these areas: international, developed, emerging markets, as well as fixed income, which is another way of saying the bonds. And then how are we applying the data that we're sharing to the families that we work for? And then we'll wrap up with Q&A. And again, please add your questions to the Q&A. Feel free to upvote for ones that you like and would like to hear more about. Okay, let's jump in. Bryan, let me turn this over to you.
So starting off with the U.S. and the good aspects of the U.S. So just like it has been for the previous quarters, labor demand is really strong. We've got more job openings, which is currently, as of end of January, about 8.86 million. And as far as people looking for work, we've got 6.4 million folks working for work. So more jobs available than folks that are collecting unemployment. You notice there we've got a little bit of a downtrend, but not really too concerned. I mean, once again, it's, we've got over 2.4 million more jobs than people looking for work. And then we'll look at this next slide a little bit as well. If you can see here, the trend from labor force, if you look at the blue, which is the labor force participation rate of 18 to 64-year-olds. It's above 77%. So it's at the top of the last 10 years. So we've got a lot of folks working that are in that age group, as well as plenty of jobs for those that are looking. So really no concern with the labor force and that situation in the U.S. at all. Similar to what we saw last month, wage growth continues to be good. As of the end of February, it was 4.5%. I think when we looked at it last time, it was like 4.3. So the wage growth, real wages, continues to be positive as the growth is above inflation. And Chris will cover a little bit more in the inflation area in the slides to follow. Okay. But really, the job situation is going well. People are making more money, and things are going good from that perspective in the U.S.
Okay, so shifting over, as Bryan alluded to, what's top on the list is inflation. Inflation's had an uptick lately over the last 3 months, and we've seen this a lot with the work that we do with families. Auto insurance has increased tremendously in the last 12 months, and this research and article is regarding the level of car accidents. People are having more extreme car accidents, so the cost to repair is higher. The vehicles are more expensive and labor is more expensive. So this is something that we've seen with lots of families that we meet with. And overall inflation here is 3.5. So you may have seen this in the news lately. Inflation has ticked up some in the last 3 months, and so we're monitoring this. We're going to be talking more about inflation throughout the presentation. And what's always interesting is to also see what's declined. So rental cars have gone down, airfare has gone down, used vehicles has gone down, and new vehicles has gone down, hotel rooms. So I think what this may also be is there was a spike after COVID where people were going to travel no matter what, no matter the price. And now that there's maybe a slightly less disregard for price, we're starting to see prices come down in this area. Airfare again, there 7%. Okay, so what else? What we're also seeing is the delinquencies for consumers within the auto and credit cards. These numbers have been ticking up, and they're slightly higher than they were 3 months ago. Student loans, we're expecting this is the next one to go up. So eventually the freeze to student loan debt payments is going to change. People are going to have to pay their student loans. And once that requirement is put in place, the delinquencies are going to rise. So past delinquencies are here in the 10% range. So it's not a concern, but we'll see this go up. But this is another example, is that's one of those sort of like, I don't know, agitating messages that we're going to hear is, oh, the delinquencies in student loan. Well, they're going to get back to a normal rate. They've been on hold for a while. Okay. So the summary, what's good about the US? Job openings continue to exceed unemployed people. This is not normal, by the way. We've shown other charts on this. The fact that there are more jobs available than people looking for work is very unique. And there's a reason why we start with this, and it's number one on the list. Unemployment remains low, and wage growth continues to outpace inflation. Those are always things you want to see within a consumer-driven economy. What's bad? Inflation remains persistent, and we've seen an uptick. Again, auto loan and credit card delinquencies. And then the last, which we didn't have a chart for, is our dysfunctional government. So the inability for our governing politicians to compromise poses some policy risks. So that's coming on a day that we get an actual bill passed today is a nice thing to see. But this is something in the bad category that we'll continue to monitor. Okay, Bryan, let me turn it back over to you.
So continuing on outside of the US, we'll look at the international developed markets to start off with the goods. So global inflation. Global inflation has come down in the other developed nations. So as far as in the UK and Europe, UK, France, since we last met in January, those inflation rates have come down by 0.5%. Japan's remained about equal. Germany's come down by 0.7. So really, all of the inflation rates we're seeing in developed countries outside of the U.S. has come down for the most part, or stayed about equal since the last quarter. As far as common theme here, just like the U.S., wage growth is up. It's up at 4.5%. So once again, in developed nations outside the U.S., the wage growth is outpacing inflation. So the real wages is on the positive side. And this chart here More look at the medium blue and the light blue. Those are the unemployment rates. So as you can see, the downtrend continues for both the Eurozone and Japan from an unemployment perspective. So their job markets, unemployment's going down and wage growth going up. So there's no concerns as far as international developed markets are concerned from a labor front.
What's bad? War. This is, each of you are going to get a copy of the presentation and these charts. This is a chart from First Trust, and it goes back almost 100 years. You see the S&P 500 here. This is the upward trajectory over roughly the last century. And so you see Russia and Ukraine here, and then Israel and Hamas is here. The concern is that the Israel-Hamas war turns into a larger global conflict, and we're all seeing what's happening in the news. And of course, Bryan and I, we're seeing it on a daily basis, and it's very much a part of what we're monitoring. In terms of the summary, what's good, as Bryan indicated, the inflation is, well, wage growth is outpacing inflation. What's different internationally is that their inflation is largely declining. So that's encouraging to see. Unemployment remains low and trending down. We didn't show this chart this time. However, it's important for you to know is that the valuations within international are attractive relative to US. So we have international holdings within all of our portfolios, and there's good reason for it. And then again, what's bad is the Russia-Ukraine conflict, as well as the Israel-Hamas war and the potential for that to escalate.
Transitioning over on the international front, looking at the emerging markets area. This here shows the real GDP growth by country. So you look at the three ones on the right, it's India, China, and emerging markets. All of them are much higher than the developed markets. Now, the trend for India, the GDP is going up, approaching 6.4% level, forecasted for last year, as in last year, and then forecasted out into 2028. So while look at China, it's still on the positive side, but as you all may have heard or seen in the news, is the GDP is transitioning downwards a little bit on China. Still positive, but it's just they're not in the go mode, unlike India, which is kind of supplanting them from a GDP growth perspective. Another positive aspect of the emerging markets is shown here. So you look at the black bar for each one, that's from about 30 years ago. 2024 is the purple bar, and the blue is the forecast. For all of these emerging markets, and these are the larger emerging markets, India, China, Brazil, Mexico, the growth of the middle class projected to increase about twofold over the next 6 years or so. Just to summarize, as mentioned on the good, GDP growth, as well as growth in the middle class across all the emerging markets is a positive aspect. The one bad aspect, which we didn't really have, it's kind of plays along the war conflict situation. We've got ongoing global military, and also we've got the trade conflict. So you continue to hear on the news this continuation of trade between China and the U.S. and different restrictions and tariffs, whether it's steel or chips. Those things continue to kind of linger on the negative side.
Okay, so now moving on to the more conservative parts of the portfolio, which is fixed income or bonds. Starting with the good. What's good is that interest rates have been level since July of 2023. You see that in the dark blue with our US Fed funds rate. You have the Bank of England, the European Central Bank here, People's Bank of China, and then all the way down here is the Bank of Japan. So Japan hadn't had the level of inflation that we've had. It's actually There are different economic risks associated with that. But what's good is that we have not seen interest rates rise. There's been a little bit of a conversation lately because of inflation that interest rates may rise later this year. Bryan and I actually don't think this will be the case. Having said that, they may remain flat for a longer period of time. We're not in a rush for interest rates to go down. They are where they are for a reason, and we believe they'll remain where they are for a reason, for all the right reasons. Let me say it that way. Okay. Because interest rates rose and you saw all that stair step over the last 2 years, we're seeing higher interest payments, and a lot of people on this call are seeing higher interest on their cash because interest rates have risen over the last 2 years. Looking forward over likely 2 years from the future, we're going to see interest rates go down. And so this gray section shows people losing money over the last 2 years because interest rates have been rising. We're well aware of this relationship, which is why we were buying CDs for lots of our clients over the last 2 years. Now that interest rates are where they are and are going to be going down, this blue section of the graph is what we're going to be seeing as interest rates go down. So we're going to be seeing price appreciation within these various components within the bond market. And this is very much a part of the work that we're doing on a regular basis. Okay, what's bad about the bonds? High interest rates. And so this right here is showing the net interest that we are paying. And actually, Bryan, I know this is supposed to be your slide.
Yeah.
So let me turn this one over to you.
No, that's fine. So net interest. So you see the highlighted the circled area on the right there. So since last time we met, while on the right side the deficit borrowing has gone down, the actual net interest, what you see on the figure you see on the left, has increased from about over $200 billion and has gone from 11% to 13% of the federal budget. So, that's a result of the higher interest. We're paying more on our continued deficit spending, even though our deficit spending has gone down since the last quarter. And to summarize the fixed income, as Chris mentioned, interest rates have remained steady since July of 23. Folks that have a high yield savings account have seen those healthy interest payments in those accounts over this last year or two. And the declining interest rates, what you will see sometime in the future, will provide price appreciation and contributing to total return of the fixed income instruments. As mentioned, higher interest rates on the bad side, higher interest rates increase the federal net interest due to our ongoing deficit spending. And one thing, we didn't have a slide on it, but the higher interest rates make it harder for companies to grow. So as companies need to finance their growth, or they have debt that's expiring and they need to roll over that debt, they're finding that they're having to pay a higher rate and hence increase their expenses and decrease their growth.
Okay, so how are we applying this data on behalf of the families that we work for? We work hard not to use a lot of industry jargon and speak as normal people, as I like to call it. The word or term duration is worthwhile for us to build a conversation around. The term duration applies to the number of years you have within a particular bond. And so you see this seesaw relationship, which as interest rates rise, the longer the duration, the more duration you have, the more the negative results. Well, we're going to be seeing the seesaw going the other direction over the next 2 years. So as this begins to happen, we are increasing our duration because we're going to be seeing price appreciation over the next several years. So going back to what we had talked about before, we're laser focused on inflation and how interest rates are going to over time go down based on the interest rates being higher to tamp down inflation. Okay, within the fixed income, so I'm repeating myself here, we're focused on inflation, interest rates, and duration. The recent rise in inflation is very much on our radar. We will be increasing duration as signs of declining inflation start to reemerge. Within the equity side, we're happy with the allocation between large, mid, and small size companies. And we're also happy with our allocation between US and international. Over time, as things evolve, these positions are going to change. There are, as Bryan and I talk about this, it's important to think 2 to 3 chess moves ahead. And these are things that we talk about on a regular basis and how we're going to be making adjustments as things move in the economy. And that's also why we host this event, to communicate those changes to you in real time. Food for thought. We wanted to end with a couple of slides. Again, I see we have a couple questions here. Please throw any questions you have in the Q&A. We'll, of course, get started with these. And as we wrap up, we're going to leave you with a couple of charts in the food for thought category here. This is the S&P 500 over almost the last 100 years, 1926. What I'd like you to see is that 7 out of 10 times, which is the blue in terms of positive returns, this is where we end up in terms of the S&P 500. And noticeably in the over 26% return category, this is the one we see the most. Yes, there are years, and 3 out of every 10 years, roughly, you see a decline, but to a lesser extent on these extremes. So we see the most in the negative 7 to 14% range. So if you apply that to yourself and you say, okay, 7 out of 10, or if we think it in terms of quarters, so out of the next 10 quarters or 2.5 years, 7 out of 10 quarters, we're going to make money. 3 out of 10 quarters, we're going to lose money. So you're going to make money twice as often as you lose money. Now, the difference is when we're seeing negative numbers, it's twice as painful to lose money than it is to make money. When your account balances are growing, you feel good, maybe about the same. And when account balances are going down, you feel much worse. But it's important to see this chart and for us to be reminded of the results anyway. And lastly, this is another chart from First Trust, which shows if you invested $10,000 in the S&P 500 back to the beginning of the 1980s, so 40 plus years, and you didn't do anything, and we ignored all of the noise and everything else, you'd have $1.5 million. If you missed the best 5 days in 40 years, over 40 years, your return is close to $600,000 less, which is hard to get your head around. If you miss the best 10 days, down by another almost 300,000. Here's almost over 400,000 missing the best 30 days. And if you miss 50 days in 40 years, my goodness, that's a fraction of what you would have otherwise. So these charts are in the food for thought category for a reason, and thought we would just share.